topic that's pretty hot right now is staking plus and staking plus plus, right? So liquid staking, restaking, etc.
I would classify them at the bottom layer, the infrastructure stack of the crypto ecosystem.
From a user perspective, what is the use case of staking apart from, of course, securing the system in and of itself?
I'll say with most investors, no. Like the first answer is like, all right, what's the expected annual reward, right? How much money am I going to make from this?
Hey everyone, welcome to another episode of the Pure Podcast where we talk to interesting folks within the crypto ecosystem. And a topic that's pretty hot right now is staking plus and staking plus plus, right? So liquid staking, restaking, etc. We've got Samuel Keller, who's the global head of business development and sales at Chorus One. Before this, we were chatting, Sam, and you mentioned that Chorus is not a liquid staking or a staking provider. You provide more infrastructure to a few clients. We'll get into that. But before that, a quick background of Sam. He's been involved in the crypto space for a number of years, working with the likes of Block Demon and Iron Forge on the Solana side and on the infrastructure side specifically. Before entering crypto, he worked at a quant trading firm called Tower Research Capital. Welcome to the Pure Podcast. Excited to speak with you, Sam.
Thanks for having me, Akash. Yeah, I'm excited to be here and to talk a little bit more about staking.
Awesome. So Chorus One, like I mentioned, I might be incorrect here in the nomenclature, is a staking provider that builds staking integrations for investors to stake tokens on, I think, 60 plus chains. You've got over 2.2 billion last I checked in stake assets, and rewards are about 300 million or so. And what's interesting is you cover a variety of chains. So Babylon, Zeta, Bearer chain is also upcoming. Monad is also upcoming. But let's get into the description of this, right? Is Chorus One a staking provider, liquid staking provider? Can you give us like a TLDR of this?
Absolutely. So Chorus One, I would classify us as a staking provider. Specifically, we stand up validators, both for public delegators, as well as white label validators for institutions, folks like exchanges, custodians, particularly large investors. Um, it might be their name on the brand, on the label, but we're running the infrastructure on the backside. Now that support carries over, and I think this maybe causes some of the confusion in the space, to liquid staking solutions. So, for example, on the Ethereum side, we support Stakewise, we support Lido, we run ETH validators for them across their product set, providing that backbone infrastructure. And we also run operators on the restaking side, which is a bit more of a novel concept. And the main restaking providers out there, again, talking specifically for Ethereum, would be Eigenlayer and Symbiotic, for example.
That's a great overview of both what you do, who you work with, and the exact product suite that you operate. Let's just look at staking from the ground up, right? Like the bottom layer of a staking service or a proof of stake blockchain would be, say, the physical layer. But at least in proof of stake chains, there is no mining rigs that you need to operate. There is a certain amount of tokens that you need to stake to participate in the validation process. That probably would be the bottom layer. And then there are layers on top of that that allow people who don't have enough capital or don't have enough stake tokens to participate. And of course, right on top is the applications that use this consensus mechanism. Where exactly in this protocol stack does Chorus One operate?
Yeah. So Chorus One and validators in general, I would classify them at the bottom layer, the infrastructure stack of the crypto ecosystem. So while we do use third parties to provision our physical servers, the actual machines, a validator can be thought of as a computer. It's the physical hardware plus the program running on it. And what the validator is doing, its job within the ecosystem, is to be responsible for verifying all the transactions happening to the distributed ledger on the network, and maintaining security of that network by monitoring the blockchain for any signs of malicious activity, any double signing. Really, what the validator is doing is taking in transactions, validating them, confirming that they're all above board, they're good. And then if they get selected by the network to propose a block, um, uh, pushing that block out to the network to be verified by other validators in the active set. So everything that happens on top of the blockchain itself, everything on the application layer, everything on the user layer filters down to the validator at the end of the day, to be verified and to make its way into the next block.
So that is on the security side, and applications need that
Mhm.
security to operate, and users need that trust to believe in the network, and to stake their assets there. So from a user perspective, what is the use case of staking apart from, of course, securing the system in and of itself?
Yeah, so that's an excellent question. And so, to take a step back, when I was first looking at crypto back at my old job at a trading firm, really I was viewing crypto assets like a currency pair or like any other financial product. It's something that you can make a market in. I wasn't going too deep into what was happening at the blockchain layer, and the technology around that. So I did, like everybody else, read the Bitcoin white paper. I thought it was a fantastic novelty, but the consensus mechanism for Bitcoin, for protocols of that era, was something called a proof of work. And that relies on mining rigs that you referred to in order to, again, verify transactions, create new blocks. And I was not, that consensus methodology didn't particularly resonate with me because I saw it as very wasteful, both in terms of energy and compute resources, and because I was not convinced that we were going to be moving towards a future for distributed ledger technology of everyone running their own consensus mechanism in their garage, right? Which back in those days was like sort of the at least the public ethos that was being promoted. Just not because there wasn't an interest there or there wasn't a desire for folks to take control of financial assets away from these centralized institutional counterparties, but because economies of scale just don't work like that. At the time, and I think my intuition was verified, I saw the tremendous possibility for concentration within these mining operators and proof of work networks, to one, centralize the benefits of mining, but to also just centralize total market share in the space. Through economies of scale, being able to set up huge data centers, being able to migrate those data centers to low energy cost regions. And so I was pretty crypto skeptical in those days. Where I really got red pilled was when I started to read about proof of stake technology. And that's because proof of stake, its consensus mechanism and its security mechanism to disincentivize malfeasance on the chain, um, permits anybody, in most cases, to stake the native asset of the token to a validator, in a sense, basically endorsing that their sense that the validator is going to do good work. It's going to maintain maximum uptime. It's going to verify blocks. It's not going to push bad transactions. It's not going to double sign. And in reward for staking those assets, or basically, kind of voting with your assets, voting with your dollars to a validator, the network inflation model distributes rewards to those validators. And each validator in turn distributes those rewards to its stakers. So if you're not particularly interested in blockchain infrastructure and you're listening to this podcast, like, what's the benefit for me? The real benefit of staking is you can take your assets, you can stake them to a trusted validator like Chorus One or one of our competitors, and in effect, you will get inflationary yield from the network that you can think of as a risk-free yield rate, similar in use cases to, let's say, a US Treasury bond or something similar. in that it represents really what should be your risk-free rate of return for providing security to the network.
That's a good way to think about it. And most people benchmark or most traders, you'd know this because you were in a trading firm, most traders benchmark their returns against Bitcoin and ETH and benchmark their yields against the chain that they're operating in, which would be the staking rewards. Ethereum, it would be what, 6-7%, Solana slightly higher, newer chains slightly higher. But you guys are on 60 plus chains, right? So, and these are all proof of stake chains. And each of these chains have their own nuances. Some of them have a different consensus model based on who actually validates it, whether it's single validator or a delegated validator, etc. So how do you navigate between the nuances within each POS chain across the various chains that you have?
Yeah, well, if I was doing this not as my full-time job, it would be hard because, yeah, of course, when I think we're up to like 70 chains now, there is some consistency in the models across chains, but there is these idiosyncrasies and differences for all of them. Um, Now, I'm a market microstructure nerd, so like this is the perfect job for me. I get to talk about these things all day long to our prospects and customers. But I think I don't know. Before we sat down on the mics, we talked about three examples of Ethereum, Aptos, and Babylon. And I think those are good examples just because they represent drastically different methodologies for your end customer to stake and different models and how they've set up, their delegation strategy. So Ethereum, among proof of stake chains, has the highest TVL. It's the most popular. It's also a bit different than most others in that Ethereum validators have the unique requirement that each validator on Ethereum needs precisely 32 ETH in order to be part of the active set and to begin receiving rewards and to begin verifying transactions on the blockchain. Now, that's very interesting from a validator support point of view in that if you want to stake more, if you want to get yield on more of your assets, it means that you need to dynamically spin up more validators. And so in the early days of Ethereum, or as Ethereum was moving to a proof of stake model, that was the main focus for validator operators of how can we dynamically support spinning up more validators should an institutional investor come in, and also how do we support the smaller Ethereum stakeholders? I'm not sure about your own portfolio, but unfortunately, I don't have 32 ETH in mine. I wish I did, but I would still want to participate in the security of the network, and I would still want to gain returns, passive returns on my Ethereum assets. Well, how do I do that without 32 ETH? And so in the early days of Ethereum, really liquid staking protocols became an essential I would say like on-ramp for a lot of stakers out there. And you saw tremendous success with Lido in serving this niche. And these liquid staking operators, what they were doing was providing a smart contract that allowed their customers or users to, in effect, pool their ETH. So maintain custody, but pool their ETH collectively, and then distribute that ETH across a wide set of validators. So Chorus One, Blockdaemon, Figment, all nodes, all on the back end, all invisible to the customer, which certainly resonated very strongly with certain aspects of the both institutional and retail staking community. For more institutional firms, those that have an excess of 32 ETH, stake providers, including Chorus One, have come up with solutions in order to dynamically spin up dedicated validators in order to scale that business. But if we start to look at things from an operator perspective, that's also quite interesting because your fixed cost for supporting more validators rises as more folks stake to you. Now, that differs greatly from, let's say, Aptos or Solana or Cosmos, where those are a delegation model method to stake, where in effect a firm can run a single validator and it is uncapped how much or how little their delegators wish to stake to them. And in effect, also there are benefits to concentrating stake on a single validator in those models. It is more likely you'll be selected to propose a new block, which generates more block rewards. And the nice thing about that from an operator point of view is that you can stand up a single validator and just keep pointing folks to that validator so your rewards increase while your fixed costs remain the same. That's not ideal from a network distribution point of view. And often there's a push-pull between, all right, we want to certainly be like the top validator, we want to concentrate stake, but we also want to, we believe, we all work in this industry because we believe in distributed systems and this decentralized blockchain. And so we don't want to concentrate, too much stake on a single validator. You want to make sure it's spread out. And for those solutions, you can spin up separate white label validators. This is a method that Chorus One does. This is a method that our competitors do. But the long and the short of it is, for the delegation model, quite easy. If you hold, 200 atoms, you can sign into your Kepler wallet, select a trusted validator like Chorus One, hit delegate, and your assets are staked and you're good to go. The last example we have in there is something that's relatively new, and that's something called Babylon Chain. Babylon Chain is an L2 on top of Bitcoin. And the reason why I want to call it out is that it highlights evolution that we see within a couple evolutions that we see within the staking space. So the first evolution is you can stake something beyond, you can stake an asset beyond the native token on the chain. So for Ethereum, you can only stake Ethereum. For Cosmos, you can only stake Atom. For Sol, you can only stake the Solana, you can only stake Sol. On Babylon, you can stake their native token, BBN, but the really exciting thing is that you can actually lock your Bitcoin. And so Bitcoin, which exists in a proof of work consensus mechanism, can be used as staking collateral to secure a layer 2 blockchain like Babylon or one of the other proof of stake chains that Babylon in turn supports. And so that's interesting, one, because we're moving outside that pure staking native token model. You can now earn yield, stake one token like Bitcoin and earn yield in the native Babylon token, BBN. But also it highlights this move towards restaking or bootstrapping L2 chains using security from the underlying chain. And so in each different ecosystem, you see different approaches to this. For Ethereum, we touched on Eigenlayer and Symbiotic, which allow you to stake Ethereum or OSETH or STETH, any liquid staking derivatives, to secure AVSs, which essentially are bootstrapped networks being built on top of Eigenlayer. With Babylon, you can use your BTC to support Cosmos Hub, Cosmos proof of chain networks. Avalanche is launching their L1 marketplace that also can be used to, you can use the native token to basically ensure security for these additional side chains. And so that's really exciting to see all these novel approaches. One, just because it's interesting, it's nice to see the benefits and detriments of each implementation in each ecosystem, but also because I think it solves a real problem that we saw during the last cycle on the fragmentation of liquidity within L2s. And so the ability to move towards these more modular designs, to bootstrap new chains without impacting or further fragmenting liquidity within the blockchain space, I think is very interesting, and it's definitely something to keep your eye on as we head into 2025 and beyond.
It's good that you gave that three-pronged distinction between Ethereum, an emerging L1 like Aptos, and something that's using a proof of work coin like Bitcoin within the Babylon ecosystem as well. Two things there, right? One is you mentioned how Chorus One helps break a monopoly of validation that generally happens in like your delegated proof of stake networks. And it does that through an institutional backing, the investors that you have or the users that you have are institutional investors. I quickly want to touch upon that before we move on to the restaking part. Was this something that you looked at from a point of view of, okay, this is a way for us to increase distribution or distributed networks, and prevent concentration of validation power, like what's happening in other chains? Or is this something that you looked at as a way for institutional investors want to come in, we'll give them a way for them to come in, and we can balance the sort of monopoly that is happening on the other end?
Hmm. Um, I'll try to answer. If I go a little off topic, let me know.
Feel free.
So I think taking a step back, we talk about like the evolution in the staking space. Chorus One has been around since 2018. I only joined the company in late 2023, early 2024, but observing Chorus One's success in the early years, it really came from standing up public validators and having, folks delegate to them without any direct BD outreach or direct sales from Chorus One. It was really more of a community project. And to this day, sort of our public community delegators still represent really the keystone of the business, right? We never want to take our eye off of supporting the little guy and making it easy. But as you've seen more institutional adoption of crypto, as you've seen more integration of staking natively into wallets, custodians, DeFi platforms, you see the natural urge for people to set up their own branded validator, which of course, One we're happy to provide. But you're also seeing, another segment there is also the VCs. The VCs that support these chains want to be public in their support, and they want to aid in distribution of the networks themselves. So you'll often see large venture capital firms stand up validators as well. Generally, it makes sense for them to outsource it because they're really good at evaluating projects and picking financial winners, and maybe less good around infrastructure management and risk mitigation policies. So it makes sense for them to outsource it to a third-party provider like Chorus One. But as we've evolved, I think the staking ecosystem has moved away from it's enough to just stand up a validator and hope that people will stake to it, or think that people will read through 5 pages of developer docs in order to figure out how to delegate. There is really a revised focus on how do we lower barriers of entry so that both individuals, smaller institutions, as well as the bigger guys eventually can meet their requirements in terms of what they need in delegation flow. And so I think across staking providers, you're seeing a lot more focus on easing that path of adoption and lowering those barriers to entry to have them secure chains through delegation, through staking.
But in your conversations with institutional investors, like maybe I'm being blunt here, do they really care about decentralization, or are they specifically looking at this from a yield generation point of view, and from like you mentioned, a risk-free yield generation point of view?
Well, it's hard to speak generally because our customer base is wide, right? It includes everybody from retail and high net worth individuals and small VCs up to, TradFi institutions and very large, well-regulated exchanges, and the custodians and wallet providers, everyone down the middle. So what they're focused on is always a bit different. I'll say with most investors, no. Like the first answer is like, all right, what's the expected annual reward rate? How much money am I going to make from this? The next question is about risk. Where do the risks exist? How do you guys mitigate them? What additional insurance and policies can protect me from any sort of downside risk? But no, I think you'd actually be surprised at the number of even large institutions that do have concerns around over centralization, in a given space, um, especially kind of on the validator side. Um, for proof of stake consensus, we kind of glossed over a lot of the details of that, but there is systematic risk if, a single provider, uh, very rarely would be a single validator, but at least a single provider controls more than a third or two-thirds of the market. Well, underlying security risk is there, right? Someone can start publishing black blocks, but the consensus mechanism says that they're good blocks and the entire system fails. So I think you would be surprised at the number of institutions that do care deeply about network health, um, network vulnerabilities. But yeah, let's be honest, most folks care about how much money they're going to make from staking.
Fair point. And that is the business model that you operate, doing quite well at that. Speaking of the business model, you guys entered into, I would say, the restaking space. You launched something called Opus ETH, right? I'd love to hear how it works, how it differentiates itself from other staking restaking solutions. And the integration of the Opus pool with EigenLayer. How does that work
Yeah,
exactly?
absolutely. So it really, the genesis of our Opus product, which is our Ethereum staking suite, our D app to simplify Ethereum, really arises around what we were just touching on, where as we've moved forward in the evolution of staking, in the maturation of the staking industry, um, we found that there was a lot of uh, uncertainty. I don't even want to say uncertainty or confusion, but there were so many different things you could do with your Ethereum, right? You could stake it, you can mint an LST token, you can use that as collateral with a trading firm, you can restake it to EigenLayer, you can restake it to Symbiotic. What does that mean? So the Opus product itself is an Ethereum staking suite. First and foremost, it's meant to simplify the process of staking, and then generating additional yield on your Ethereum through either the minting of an LST token or through using a restaking platform like EigenLayer or Symbiotic to collect additional yield on your staked assets. So I threw a lot of words there. I'll break it down a little bit simpler. Opus, as a product, makes it possible for our customers to stake any amount of ETH, foregoing that 32 ETH requirement. It enables auto compounding of rewards, which means that as your rewards generate, should you generate enough that collectively we can spin up another validator, earn additional yield. It does that automatically. It supports on-chain distribution of fees, which anyone who used a validator early days of Ethereum staking knows what a pain in the butt that invoicing and payout process would be between execution and consensus layer rewards. And all of that staking additionally leverages Chorus's proprietary MEV client. So we haven't talked about MEV yet here. I won't go on a full detail spiel about it, but MEV can be thought of almost as an arbitrage strategy using the TradFi example, to participate in timing games to generate additional yield for our staking customers. And so that's something that's unique to Chorus. It's unique to Opus, where in effect, by using our proprietary client, you're getting additional 8% MEV rewards compared to the industry standard. That translates into about 10 basis points per year of additional Ethereum staking. So that's all well and great. Using Opus, you know that you're getting, first in class staking rewards, but might be like, all right, well, how do I further monetize it? And Opus simplifies that process by either allowing the fully discretional option for customers to mint an LST token. And then you can take that LST token, for example, and again, using Opus, restake that LST to our EigenLayer operator. And EigenLayer and Symbiotic, we've touched on it briefly previously, but those are restaking platforms that allow users to take either their native Ethereum, native Eigen token, or any Ethereum-based LST, and in effect stake that to an operator, and that operator is in turn running AVSs. And I'm throwing a lot of acronyms at you, but AVSs, you can think of them as L2 or L3 blockchains running on top of the Eigenlayer protocol. Now, where customers extract additional yield by submitting their assets to Eigenlayer is that for doing so, they are paid out programmatic rewards from Eigenlayer itself for securing these blockchains on its network. And so automatically you have additional yield there. As these AVSs continue to mature, these AVSs will also start minting their own tokens, native tokens, that anybody who is securing them with their LSTs, with their liquid stake tokens, get an additional source of yield. So again, it's an overused example, but it's sort of like taking your US Treasury bond and using that as margin for a trading firm or per a trading account. Now, it's not a perfect example because restaking and staking is not trading, it's not DeFi, it's reward generation based off of work being done at the validator level. But I highlight it because it represents a distinct use case for your staked Ethereum, for your staked assets. You can be collecting yield on an asset that you're using to collect yield.
It's interesting that you describe it in that layered approach and sort of compare it to high frequency or trading in general in the TradFi example, because there is a higher risk that one takes on with restaking compared to staking, because you're reliant on a less secure but more need for security layer 2, layer 3, like you mentioned, or a protocol. But you guys, at least through Opus, that amount of security is maintained, and you pretty much get competitive field through with top tier MEV yields, right? How do you balance that?
Absolutely. So there are a couple things that I want to touch on there. So yes, restaking is, I would say, a slightly riskier prospect than staking your ETH directly and leaving it there. That underlying risk comes from the quality of the AVSs, the layer 2, layer 3 blockchains that validator is running. So Opus itself as a product, what it does really, really well is simplify that entire flow so that you can go from staking your ETH, minting an LST, restaking the Eigenlayer in 4 clicks. And that is really the use case and the advantage of using it. Now, when it comes to mitigating your risk on the restaking layer, you also benefit from coming to Chorus One as an operator, but that is unique to Chorus One's risk review and analysis, rather than anything specific to the Eigen product. And so when evaluating, these AVSs on Eigenlayer, a lot of these projects are fantastic projects, very strong development teams, have a clear use case. But because there was such an exciting, hypey initiative that came out, I think that there is a wealth of AVSs out there that do represent significant risk, either in terms of protocol design or general poor practices or how they manage their encrypted key pairs. And one of the disheartening things I think that I'm not speaking for Chorus, I'm speaking for myself personally. One of the disheartening things that I saw around that rush was that a lot of these AVSs, in order to capitalize on the hype, really pushed out projects before they were ready, which is understandable. But at the same time, there was so much excitement within the blockchain community around airdrops and airdrop farming, that you saw a very strong urge from a lot of both investors and validator operators to just support the highest number of AVSs possible. That was not the method that we decided to go with at Chorus One. That did not align with our security paradigms, nor our expectations for the quality of blockchain networks that we support. And so I do think that is a valid risk vector for folks to evaluate when they are selecting an eigenlayer or symbiotic operator. Now, one of the encouraging things that we've seen in particularly eigenlayers approach recently is that they have just recently released the capability to distribute inflation yield, programmatic yield, they call it, its staking yield for eigenlayer restakers, and that's great. It's works very similar to staking on an L1 in that it is a deterministic yield, it is predictable, it is inflation coming into the market, but the qualification for receiving maximum rewards or maximizing your yield in eigen tokens is not deterministic on the number of AVSs supported. It is proportional to asset staked, which means, hey, you stake more, you get a bigger slice of the pie. But by removing that incentive for validator operators to just support the widest number of AVSs, whether they're legitimate or not, means that AVS operators can now take an approach more similar to Chorus One in that they're supporting bona fide projects. And it can trim some of the fat and remove some of the risk from eigenlayer restaking. I will do a shout out. The Chorus One of our differentiators is that we have a really tremendous research team that does both quantitative and qualitative analysis. If you're interested in a deep dive into our risk methodology, which uses a Monte Carlo simulation to analyze risk on these ABSs, I would direct folks to Chorus One's research page to read in a bit more detail about our methods there.
Oh, we'll be sure to link that in the show notes, as well as wherever we put this out. But the risk of restaking, specifically when there's a bunch of AVSs, some of them are chasing airdrops, and users are chasing those airdrops as well, because that is the meta right now. How do your institutional investors sort of sit with the risk of these AVSs? And more than that, of course, like there is, of course, like a regulatory risk when you're dealing with high net worth individuals, TradFi institutions, etc. Market conditions aside, there's a regulatory risk and there's a risk of poor judgment of these AVSs. How do these institutional investors sit with that? And have you spoken with them, and what do they think about this risk?
Yeah, I think again, every investor's risk profile is a bit different. Every institution's risk profile is a bit different. For a lot of folks, especially on the more institutional side, especially on the TradFi side, they are just dipping their toes in staking and getting clarity on basic staking. So as soon as you start mentioning even like a liquid stake token, not even talking about eigenlayer yet, but just a liquid stake token, they probably would prefer to have more regulatory clarity, especially in the US, around those aspects before even diving into eigenlayer. Now, there is a very large set of more crypto native people that would be classified as institutional investors, but I would view as more kind of crypto native, crypto savvy, and their willingness to explore these benefits and to understand these benefits on a core level means that we do see a lot of engagement, even among sort of crypto native institutions on eigenlayer restaking, on symbiotic restaking. So those sort of more crypto native institutions, the folks that were here in the early days, of 2015, 2016, they're really leading the vanguard in terms of putting out the requirements that they need in order to capitalize on these restaking opportunities. But in terms of like the suit and tie folks that are evaluating opportunities in crypto, they are staying away from restaking, at least for the time being, until it's a bit more of a mature market.
But within staking, direct staking or indirect via you, are they more open to going to like alt L1s, Aptos? Maybe Babylon might be far-fetched, but the Bitcoin angle is a good big selling point, right? Are they expanding vertically, or they're just like, hey, I'm getting a 6% risk-free rate on Ethereum, let me just double down on that?
Yeah. So I would say yes, they are starting to open up to more altcoins. Um, and so without disclosing any names or anything in particular, we are seeing, again, even more kind of like exchange traded fund interest in the longer tail chains beyond Ethereum. We are seeing more and more alt chains being used as like pseudo crypto reserve currency, or however you want to spin that. But in terms of TVL among that suit and tie crowd, it's still Bitcoin, Ethereum, and the newcomer there is really Solana. And so we continue to see a lot of adoption on Solana. It continues to pave its way really as the market leading blockchain for things like payment, fast transaction times by traders. The deterministic fee model on Solana resonates a lot with these use cases. And so I think you're certainly going to see a lot more adoption within the Solana space, um, as Ethereum and Bitcoin continue to be sort of the two pillars of that institutional investor set. But no, yeah, we're seeing a pretty steady adoption rate of protocols like, say, SWI, Aptos certainly belongs there. In the Cosmos ecosystem, Injective, Celestia, Osmosis all maintain strong popularity across the entire customer cohort spectrum.
Institutional investors would probably not be the biggest participants in governance because they have their own capital to manage. But you guys hold $2.2 billion in staked assets, much of which can be put into solid governance use. So do you participate in that? Do you collaborate with other token holders, other validators? And when you form a stance, how do you work with the foundation's internal decision making?
Yeah. So, I mean, to provide some background to your listeners, because I think governance is a super important topic that does not get a lot of attention, because if you look on crypto Twitter, like all they care about is sort of controversy and revenue, which is fine. I get it. But governance is hugely important in these decentralized systems. So I'm glad you're shining a spotlight on it. So for your listeners, um, in decentralized system, governance plays a key role. These are changes up to on the protocol level of parameters, of behavior, and how each blockchain handles governance is a bit different. So in the cases of blockchains like Ethereum, Solana, and Bitcoin, governance is absent at the chain level. So basically, the future of the blockchain itself is typically managed by a group of core developers, or a foundation, that's charged with overseeing development and health of that blockchain's ecosystem. That system can work quite well. We just listed three protocols that are the top three in the world. They're able to generally make decisions a lot quicker, but it's a less democratic process. And because of that, you often see a lot of dissatisfaction within the community on certain direction, and certain actions taken by either the foundation or the core devs. Now, if you want a counterexample, in the Cosmos ecosystem, and this covers, like I mentioned, chains like Cosmos and Injective and Celestia and Agoric and many, many others. Governance, there is a governance system at the chain level. And this ensures that the chain isn't dictated by one centralized party, but truly, or one centralized validator or a small set of validators, but truly is governed through democratic process controlled by the token holders. And so at Chorus One, we take governance very seriously. If you look at our participation rate, not to pat ourselves on the back, but if you look at our governance participation rate on Cosmos, I believe we're at like 85% of proposals. If you look at like the other top 20 validators per chain, like they're somewhere around 60. So they're certainly still active, but it's definitely deprioritized, I would say, from them. The context of why we put so much importance on governance, outside of the fact of like, we're all blockchain native, is like whether you exist in a democratic government or you exist in a blockchain ecosystem, part of your civic responsibility is voting, is participating in forums, and engaging with the community in order to enact proposals that work for the largest subset of that community. Um, so in term again, like so, of course, that we don't get paid for governance. We don't rarely, kind of get any credit for this work that we're doing. It is a lot of work, but it is a foundational focus of course one because we believe this is what should be required from every validator operator, from every good citizen within these blockchain ecosystems. So our general flow for governance is we'll first conduct some research just to make sure that the proposal being presented goes through all the bureaucratic rules, that it has kind of a sufficient announcement date within the forums, that yeah, it's followed sort of the bureaucratic steps needed for a proposal to go through. If it didn't do any of those, we'll generally abstain because we're, it's sort of like a false start. But if it has gone through that process, we'll conduct our own research, weighing the benefits and drawbacks of the proposal to the larger community on the chain. We'll also reach out to all of our stakers, at least the ones that we know of, and listen for community feedback in public forums like Discord and Telegram and Twitter. We'll also examine the main protocol internally, running analysis on what it would mean for us, what it would mean for the larger ecosystem, and comment on the forums with our findings, publish our research in effect when it is a particularly important subject or a particularly controversial subject, so that we can, again, make sure that we are being transparent, open, and actively engaging in the community. Following that process, we'll conduct one last in-team discussion if the decision still isn't clear from our perspective, and then we vote. And generally, most governance votes are stake weighted. So, he who has kind of most stake wins, collectively aggregated from across the community. And yeah, that's our general governance ethos. So we're definitely steadfast in our commitment to this. This is a topic that does not get enough attention within the broader community, but it is super encouraging that we do see large sets of stakers, developers, venture investors, validator operators like Chorus participating in these votes and defining the future of these blockchains together.
Just a quick question that when you say it's stake weighted, it is dependent on the staked assets of the supplier, which would mean like your customer in this case, right?
That's right.
And they actively participate in this stake weighted decision making, or I'm guessing an institutional investor, a singular investor would probably not be that active. Hence, he or she would delegate that decision making to you.
Yeah, so it's different on each protocol. It's slightly different. In some cases, they are delegated to the validator. In some cases, it is direct stake weighted voting. But again, that only highlights why it's important that we're transparent with our deliberation process, with our activities, and why we proactively reach out to our institutional investors on that front. And don't put down the institutional guys. A lot of them are quite committed to making sure that whatever government's votes go through are for the broader health of the ecosystem, because they are just that. They've invested in the ecosystem, not necessarily the token. And so, yeah, often they care a lot about proposals happening on chain. Sometimes it gets a little too developer heavy for them. We talk about like, we're changing this parameter and X parameter and this deployment and that deployment, and they don't really care about that. But when it becomes about behavior of the underlying behavior and health of the blockchain itself, yeah, they're quite engaged.
That is a pleasant surprise. It's good to hear that they're not only putting the money where the mouth is, but they're actually using the mouth to make the right decisions, which is always good. And you guys have 70 plus protocols or chains that you support, right? And of course, the big ones are the ones that we all know. But beyond that, is there more institutional interest, either from a staking point of view or at least a conversation point of view, on any smaller L1 that your investors or your customers are looking at?
Yeah. And so again, like it's tough to speak like for all of our customers. Because like, for example, a lot of our customers who are institutional investors are venture capital firms. And so they've betted on a lot of on a lot of smaller networks, right? That fit their thesis, they think have the promise to boom. So from a VC perspective, right, they're always looking at the long list of protocols that we support. Um, and especially you see that hype around newer chains. And so this year, there's several high-profile chains that are either in the process of launching or preparing to launch. The ones that come to mind are that we haven't mentioned already. Barachain, for sure, has very strong community focus and a very avid community investor set supporting them. Nillion, Anisha, um, uh, yeah, there's just a lot. If I have to be honest with you, like the most contentious discussion at Chorus One is around prioritization of new chains. If you saw our everything that we wanted to launch this year, the list would probably go on for, 4 pages long. But there's only so many development cycles in the day. So even though and we deploy probably two to three new chains a month, the list is always growing. Now, how we assess the opportunity on each of these chains um, is quite collaborative, I would say, internally. So, as some background, Chorus One is a 100% employee-owned company. We don't have outside investors. We don't have VCs knocking on our door and saying like, "Hey, I invested in you guys, and I invested in this, so you guys need to support this chain." We have full autonomy in which project we choose to support. How we end up making that choice is a series of factors. Institutional demand is something that I care about because I work on the BD and sales side, but it's only one factor in whether we choose to pursue a chain. Um, Underlying code review and tech due diligence, I would say, comes first and foremost, making sure that we're supporting high quality technology and infrastructure, quality of the team, quality of the ecosystem, unique product selling point. Does it really serve an additional need in the market, or is it just another L2 that's gonna, that found venture investments and isn't really adding anything new to the ecosystem? So we evaluate that prioritization across our engineering, security, networks, business teams, with direct buy-in from our leadership. Um, and so, when it comes to institutional demand, like that's certainly something we take under consideration, but it's only one piece of the puzzle.
You're certainly doing that. I didn't know you guys were bootstrapped, but that's quite quite a feat to build such a vast staking providing pool for institutional investors, no less, and to do that with your own money. But that has been quite interesting to know. Actually, a lot of this has been quite interesting to know. But thank you so much, Sam, for speaking with us. This has been a interesting discussion on staking, restaking, the avenues, the products that you have, and also a very good learning experience for me and everyone who's listening on the difference in POS chains and their staking mechanisms. So super work there.
Excellent. Well, it's been a fun conversation. Hopefully, I didn't bore you talking your ear off about proof of staking, but like I said, I love talking about market microstructure, and it's been great to speak with you, Kash. Thank you for having me.
Awesome. I'll be sure to link everything in the show notes, and especially the research and the handbook and a link to Ethereum Opus that you have already. And with that, where can listeners, readers find you on socials?
On Twitter, you can find me at Sam_Klehr, Klehr. On LinkedIn, for all my business buddies out there, you can find me at Samuel Klehr. And to get into touch with Chorus One to learn more about staking, to review our services, the best avenue is probably staking at chorus.one.
Awesome. We'll link that everywhere. And thanks so much for talking to us, Sam. And I'll let you go after this.